I think part of the root of the latest leg of the rally has been sort of short covering, particularly sort of in the tech sector with the sort of the focus on AI. And then additionally, the fact that the US economy has proved to be a bit more resilient than sort of expected this year has helped people to think that maybe we can sort of escape without a recession. That's not enough ultimately. I think you've still got the lagged effects of Fed tightening coming through. The second half is going to look worse. The data's not going to be there. It's not going to be a disaster, so it's not going to be a moderate or a large recession. We might even escape with a borderline sort of recession, but the feel of it's not going to be as good in the second half of the year, and I think that ultimately weighs on the market. We can see the S&P 500 coming back down to 4,000, potentially 3,800, but then building back from there, because I think the structural story into next year is good. The Fed are overdoing it. I think when they sort of come to see what they've done by this time next year, they'll be cutting interest rates. So we're looking for 100 basis points off the Fed funds rates. So the S&P 500, 4,700 will be in the next bull market next year.
Will it be too late by then? I mean, I look at a lot of data that's sent to me very kindly by various correspondents about household finances, about the speed of which this COVID buffer of excess savings has been eroded in vast amounts of the market, how auto loans are really struggling, about how delinquencies in certain parts of the market are really picking up. I appreciate these very specific areas as well. But when you add all that to the refinancing commitments of individuals, corporations, even at government level, that's got to happen over the next year, 2 years as well, it just says to me that maybe this isn't as quick a rebound story as perhaps you're painting.
I think in the US that we've got to remember that the bite in terms of interest rates is probably coming more through the corporate sector than the household sector. There's
even
a lot of
6.5–7% for mortgage rates.
There's a lot of fixed rate financing, so the flow through from the policy rate to the way that it hits Main Street in the US is less. The other thing is that although there are parts of the US that are hurting in the household sector, generally the household sector deleveraged from 2008 and is actually in a pretty strong position at the present moment in time. You look at sort of the net wealth, that they have: cash, houses, equities, pensions, and you're talking 120 trillion of assets, excluding borrowing. It's a very strong position that the households have, and that's one of the reasons that consumption's actually held up relatively sort of well. So yes, there is a deterioration which we think is going to occur, but it's not going to sort of fall into an aggressive recession. It's going to be a borderline recession followed by recovery into next year.